Good morning, everyone, and thank you for joining us today. My name is Max Bergmann. I'm the director of the Europe-Russia Eurasia Program here at CSIS, and welcome to an inaugural live recording of our podcast, The Eurofile, where we examine Europe through a Washington lens. And if you enjoy today's conversation, please go and subscribe and leave us a review and sign up to the podcast wherever you get your podcasts. It's called The Eurofile. We're going to have a great conversation today because we're going to dive into the future of the euro and the future of the European economy. There's been a lot of disruption and concern about high U.S. debt, about U.S. economic policies, about the disruption to the global trading order. And that has led to questions about maybe there's another safe asset out there in the world besides the U.S. dollar. Perhaps that could be the euro. The euro is a currency that has been created over the last few decades and has been increasingly used by more and more EU member states. Now 20 EU member states use the euro, used by 350 million Europeans, and so it's become quite an important currency and is also important to the future of the European economy as Europe looks to the future of all the things that it needs to fund, whether it's Ukraine, whether it's its remilitarization, whether it's supporting its elderly as they continue to age. So with that, we're going to have a fantastic conversation today. I am joined by two excellent colleagues. First, Federico Steinberg is a visiting fellow here with the Europe, Russia, and Eurasia program here at CSIS. He's also the Prince Asturias Distinguished Visiting Professor at Georgetown University School of Foreign Service, and he's a senior analyst at the Elcano Royal Institute in Madrid, close friends of CSIS. He also specializes in international political economy with a strong focus on European economic and monetary integration. And then we are really excited to have Nicolas Véron. He's a senior fellow with the Peterson Institute for International Economics. He's also with Bruegel, where he helped create Bruegel. Bruegel is one of the leading think tanks in Brussels, really thinking about European economic policy from the center, from the core of where it really takes place in Brussels, I guess, as well as in Frankfurt, where the European Central Bank is. His research focuses on financial systems, on financial reform around the world, including global financial regulatory initiatives and current developments in the European Union. Federico, maybe I could start with you. The European Union is right now having this big debate, discussion about reparations loans. Basically, what's happening is the EU is realizing that the United States is no longer going to be a major financer of both Ukraine's economy and its military. The last year, we had the United States Congress pass massive amount of funding for Ukraine, and there's no that's not going to happen. It looks like under the Trump administration. So Europe is looking at ways to tap funding, and they're looking at frozen Russian assets that are in the Belgian financial institution Euroclear, and so they're thinking about not necessarily seizing that money, but doing a loan based off of those assets. It's rather complicated. And the question is, why don't they borrow more? And maybe you could talk a little bit about Eurobonds and how you sort of see the current state right now of the euro and how the Europeans are looking to leverage the euro to finance all the things that they need to spend on.
Thank you, Max. Thank you for having me again. And I guess we'll discuss the loan with Nicolas, who has been working extensively on this issue. Let me start with this basic idea of hegemonic currencies and why this matters. Basically, the dollar is the global hegemonic currency. It has been so for at least last 70, 80 years. Some academic discussion there, interwar period or after 1945. Clearly, having the capacity to issue the global reserve currency gives you a number of advantages. It reduces the cost to finance for governments, for households, for companies. Basically, Ken Rogoff has a new book about the hegemony of the dollar, saying that on average, maybe it's like 0.5% to 1% cheaper for the US to finance itself. That's important. And then when we talk about geoeconomics and power. The dollar can be used as a weapon, but this is kind of dangerous sometimes because, as people like Abe Newman and Nicolas Farrell has pointed out, weaponizing the dollar can be advantageous, but can also be tricky because others might think twice about using it less. So overall, the European Union has, issued the euro, created the euro in 1999. Then, there was this horrible, terrible financial crisis and Eurozone crisis 10, 15 years ago. Many people thought that, particularly in the US, that, since the euro is not an optimal currency area, perhaps there would be exit from the euro, particularly Greece. But at this point, I think it's clear that the euro is going to stay here. It's when you ask people, do you think the dollar is going to be around in 50 years? Everybody says yes, probability 99.5%. You ask the same question about China, probability 99.7%. But then when you ask about Europe, I think it's in the high 80s, but it's not that high, right? So the idea is you need some fiscal union, some deeper political integration. And then, as you were mentioning, in the current context, that the euro has established a reputation, particularly with a leading role of the European Central Bank, low inflation, rule of law. And in the discussion about having, more geo-economic weapons or the new toolkits, the Eurozone is doing a lot on trade, but this is the financial part. There's this discussion of, let's issue more common debt. Let's issue more Eurobonds, which could potentially reduce the overall cost for Europe and finance some of these European public goods. Defense, of course. There's a prior experience with next generation EU funds. This has worked, I would say, quite well, both in terms of, helping the European economies get out of the COVID crisis. But then it's, there's a big discussion about if the political consensus is there. It doesn't seem to be there, and some obstacles. But I guess we can discuss this deeper with Nicolas.
Maybe let me follow up. I think you've done a great job setting the stage, and I was sort of jumping ahead to the final act. But maybe to set the stage a little bit more, you could talk about. There's been a lot of controversy about the euro, and your point about. Is the euro going to be there in 50, 100 years? I would say yes, but I could see the level of confidence, and if you're an investor, that's a crucial issue. And maybe for both of you, how do you reflect so far on the history of this currency? What sort of drove it? The controversies that happened over in the euro crisis, where you had differing rates of borrowing, especially between the South in Europe and the North, which still exists somewhat today, but the sort of fractures within the European economy, then having a common monetary policy, a common currency, not really have a common fiscal policy. There's a lot of deep debates in the economics field about whether this was a wise course of action. Where are both of you now on where we are currently with the euro? So I think that sort of sets the stage before we go into, should the Europeans start, issuing a lot more debt? But Nicolas, maybe start.
I think the first thing that has to be said is that the first thing is thanks for having me. The second thing that has to be said is the euro has passed its first tests of resilience. As Federico rightly said, the Eurozone crisis was a major existential sequence that lasted about 10 years, from 2007 to 2017, I would say, had several moments of climax, one in 2011, 2012, a second one in 2015 with Greece. And really, there were many moments during that sequence during which it looked like the euro might disappear overnight, that there could be a breakup in the very near term. We're no longer there. So for at least the last 8 years, we've no longer had this perception that the Eurozone was at immediate risk of breaking up. And that may come back. I don't think it will come back the same way we had it during the Eurozone crisis, precisely because the Eurozone crisis has demonstrated to the world, but also to Europeans, that the euro was much more resilient than it was often given credit for. The second point, or the other point I want to mention at this early stage of our conversation, is how popular the euro is with European public opinion. And you see that in every single member state, of course, with some differences, some variation from one member state to another. But the eurozone the euro as a currency is overwhelmingly popular with public opinion. It's not an elite phenomenon. In many ways, you might have more nuances in that support in the elites than in the population at large. Indeed, that support is rising, not decreasing. So at this point, the level of support in public opinion is at record high. I'm mentioning that because that's not necessarily what you get from the international news coverage of the Eurozone. And it's an important reality, which is very well established in all the opinion research there is, including reference studies like Eurobarometer, but also many others. So when you see, for example, the French far right. 10 years ago, Mrs. Le Pen was advocating Frexit, the exit of France from the Eurozone. She believes apparently that this made her lose the election in 2017, and she's no longer advocating it. So I think this is very illustrative of the fact that the Eurozone has not only demonstrated a capacity for survival, but really won the hearts and minds in many ways of the European public.
Yeah, I would add up to what Nicolas was saying, that the political capital that has been invested in the Euro project is really difficult to understand outside of the European Union. The sacrifices that, for example, some of the Baltics made to join very fast, the sacrifices that some of the Southern European countries made in order for the Euro to survive were really remarkable. And this is something that, is creating sociologists, the sociology of money has a research line on this about, having lived through this experience together, young generations don't even think in terms of the old currencies. This has something. However, and this is very important, the euro
Can I just say on that? I mean, I remember in backpacking around Europe and going through France, Spain, and Italy in 2001, and having francs, pesos, lira, changing money, Deutschmarks, and then suddenly on January 2022, all one currency. It was this sort of shock to the system, but in a shock that was in a continent that was increasingly becoming integrated. People were traveling back and forth. It made things easier. I think not just for people traveling around, but for businesses and for others in Europe. But
absolutely, I was going to say. For Europeans, the European Union many times is Schengen, so capacity to move without showing your passport. The euro, not having to exchange money, and then the Erasmus program if you are studying at the university and having this experience. But the point I was going to make is that this doesn't mean that the euro is completely well constructed in its architecture. So basically, and we'll talk about this, there have been some important efforts in a number of issues, supervision of the financial system. Nicolas is an expert on this, but also some people still say that this is an orphan currency. Basically, it's not clear who the ultimate taxpayer in the Eurozone is, and this is important for markets. And also the issue of the fiscal union and of the different elements of the banking union. There's no deposit insurance mechanism scheme at the Eurozone level. So there are things that need to be done domestically to reinforce financially the Eurozone, and then think about Eurobonds, think about the foreign affairs part of the European Monetary Union.
That's true, but I think the way to think about it is that during the Eurozone crisis, the risks that could lead to the breakup of the Eurozone were very close. We were close to the cliff edge at several moments. At this point, they appear very remote. And I think they are indeed very remote, and we'll discuss that. What is the plausibility of a scenario that could lead to breakup? I think at this point, the plausibility is very low and likely to remain so. Of course, it's never zero. It's not zero for the United States. It's not zero for China. Federico alluded to that. It's certainly not zero for the Eurozone, but I think we're talking about increasingly remote scenarios. There's a twist to that, which is the more remote the scenario, the less pressure there is to act. And I think we will come to the things that should be done to make the euro even more resilient, even more sustainable, and they're politically difficult precisely because the scenarios of breakup are so remote, and that's not a prompt to action. Now, you mentioned 20 member states. Let's not forget, in a few weeks, there will be 21. Yes. Bulgaria will join, and you will be able to backpack to Sofia and the beautiful landscapes of that country without having to change into the local currency.
On that, this is like the basic landscape, and I would say here is where perhaps for the first time external factors might accelerate work towards deeper economic, financial, and monetary integration in Europe, which would be something really new because up until now the European project has moved forward basically because of domestic forces, right? And this is where we can discuss.
Yeah. I want to get there in 1 second, but maybe we could just quickly unpack what was the reaction to the financial crisis. We talked about how the euro was on the brink of collapsing. Greece even had a referendum of whether it actually would make sense to leave, and there was Germany at times, or certain German officials were encouraging Greece to maybe step away, and there was real concern of contagion of other countries and having to leave. What were the actions taken? I mean, the mythical Mario Draghi coming in and speaking in London and saying that the ECB, the European Central Bank, will do whatever it takes to back the currency, something that hadn't been said before, is sort of seen as that hinge point where the kind of history of the euro turned. But what other steps, how impactful was that? Maybe we could just unpack sort of how the euro has sort of gotten out of that present crisis where now it looks like a stable currency. Nicolas.
So a couple of things here. First, there were policy actions that were taken in the euro crisis that were fundamentally stabilizing. The first one, of course, was to provide financial assistance to struggling member states. There was a lot of debate about that. Initially, the market thought it's a no-brainer, struggling member states will be bailed out. But that's contrary to the treaty, and things turned out to be more complicated. So that's how the crisis escalated in the years 2009, 10, 11. And then the member states found gradually, painfully, a doctrine in how they could provide financial assistance to struggling peer member states without breaching the treaty. And for that, they went increasingly organized. They created a permanent vehicle called the European Stability Mechanism. They created a doctrine of how to think about conditionality in complementarity with the International Monetary Fund, which also played a role, but also providing an ability to grant that kind of assistance, even in the absence of the IMF, if things had to come there. The second thing, which to me was really the key point of the crisis, this was not a pure fiscal crisis. Of course, Greece was mostly fiscal. But when you look at the Eurozone crisis more broadly, it was a much more complex interaction between government finance and banking sectors. And particularly the fact that banks were participating in the financing of governments created a nexus between banks and governments. It was called the bank sovereign vicious circle. Some people refer to the doom loop between banks and sovereigns. And that became the core engine of the crisis, increasingly visibly through 2011 and early 2012. And this is really where the most perhaps structural action was taken with what is referred to as banking unions, the creation of a single supervisory mechanism for banks to make sure that banks were under the oversight not just of individual member states who could game it for their respective sovereign financing purposes, but a neutral third party, the ECB, working for the entire European Union, but also mechanisms of risk sharing in the management of banking crisis. And that was a key turning point of the crisis. The point that often gets forgotten about the famous Mario Draghi, whatever it takes, is that he only said it a few weeks after the political decision by the political leaders, the heads of state and government, in late June in Brussels to create the banking union. And in the aftermath of that, Draghi has been as explicit as he could possibly be, which means not very explicit because he's a central banker, that there was a causal link between the political decision to establish the banking union, to create that solidarity, also to entrust the oversight of banks to the ECB, which was a big show of support institutionally to the ECB from the political side, and that gave him the space to conduct this kind of market intervention that was his famous words. Now, I also want to say So the Eurozone crisis was over, we can discuss, probably in mid-2017. I think that's a workable chronology. That's a long time ago already, and things have happened since then. First, the geography has changed. You mentioned the periphery and center kind of dynamics between the south and the north. This has changed completely. Now, France is a periphery. Greece is closer to the core. If you look at yields and spreads, and of course, Spain is a model child that everybody wants to emulate. So, in terms of growth as well. So, the mental map that was very prominent during the Eurozone crisis, that you had the kind of virtuous north, sinful south that didn't have fiscal discipline and so on, this has changed entirely. We have a different map now. France is a problem child. I say that with sadness, being French myself. But a lot of the countries which were problem childs during the Eurozone crisis are now in a very good place. The second thing that has changed, and Federico has mentioned it, is that in 2020, when COVID-19, the lockdowns, has created a massive shock to the European economy. At that point, European leaders have decided to issue EU debt at scale. And this they had never done. They had issued EU debt before, but never at scale. So this so-called Next Generation EU, NGEU, debt issuance and common spending program, which went into the high hundreds of billions of euros, so a significant amount. It is temporary in nature. It is limited, but at a high level. It implies transfers between member states, so it's not everybody gets their return. No, it has distributional consequences. So the member states that need more money get more money. This was a game changer. It is not a fiscal union because, again, it was limited in size and in time, but it was a major step to demonstrate to markets that when there is a need for this kind of things, then this kind of thing can come. And I think if you think of the resilience of the Eurozone, the fact that the Eurozone crisis will not happen again the way it did, the fact that there was this demonstrated capacity to issue joint debt at scale, even without a permanent safe asset, that was a game changer. And that really has a big impact on market perceptions.
If I could sort of sum up institutionally, it seems that this sort of hit the classic Jean Monnet, the father of the European Union, saying Europe will be forged in crisis. There's an effort, there's a negotiation over creating a common currency. In that negotiation, there's numerous sides that creates gaps. Any kind of negotiated outcome, especially in kind of a political context, results in it's not going to be perfect. The crisis in 2008 then reveals some of the gaps and challenges within the currency as it's structured. That then leads to banking union, other steps, Next Gen EU in response to COVID, i.e. the EU borrowing suddenly. But maybe, Federico, if you want to comment on any part of that, but maybe the broader question then about sort of the fiscal union, because it does sort of seem that one of the big gaps here, just structurally, is that the Europeans have created a monetary union, but not a fiscal union. So what happens is that, like with American states can't have debt. The federal government can have debt, but not the member states. The way it's supposed to work in Europe is that, well, there's a Stability and Growth Pact. Debt, at least previously, was capped at roughly 3%. But then we've seen countries break that. There's no real ability to enforce that. But there's also no fiscal policy. So what you then have is, what was the perception, is that basically the EU was sort of enforcing austerity, limiting investment, as countries couldn't really spend their way out of problems or couldn't get other forms of investment. There was sort of no stimulus coming in. So how do you see the kind of fiscal challenges facing Europe, especially in a constrained debt environment where you can't really stimulate when you had a downturn, which seems to have been at least the Greece and Spain and others in Italy during the Great Recession?
Yeah, absolutely. As Nicolas explained, during the Eurozone crisis, on the fiscal side, there were a lot of sticks and perhaps not enough carrots. And this was somehow different with COVID, right? So there were these austerity policies that were necessary in many countries to make necessary adjustments. And then, of course, the discussion is maybe the ECB could have started acting as a lender of last resort before. We would never know. But and then the implications of that austerity also had profound consequences on the political systems. The extreme left, extreme right parties, similar to other places. Some people even say austerity is what ultimately caused Brexit. So, but absolutely, when we have a crisis, there's a necessary reaction, and with COVID, this is not exactly a fiscal union, right? So this is not the Hamiltonian moment people talk about in the US, that, okay, let's forget about the debts of member states and send everything to the center, to the core, to Brussels. The problem is that in the United States, you know, the timing and the sequencing was very different. You first have the United States of America, you have a country, and then you start creating common spending. In the European case, it's the other way around. So member states have large public spending measures, you know, from 35, 40 to 50-something% of GDP, and the discussion about sending, you know, the fiscal element to Brussels without significantly reducing the part that is spent at the level of the member states is very complicated, and some political elites don't even want to talk about it because they would lose some capacity over that spending, right? So this makes it complicated, and this makes, for example, some people saying, look at the proposal of the European budget for 28 to 35. This is not big enough. This is still around 1% of European GDP, a little bit higher. And some people are talking, there's a need in this geopolitical environment to have a larger European budget so that, more money from the countries, from the member states, goes to the central budget in Brussels, and then we redefine the spending categories along the lines of defense, technological innovation, climate change issues, etc. Now, that is under discussion, and that's where the discussion on the safe assets and the Eurobonds appears. But politically, it's very complicated, and Nicolas, that is closer to the reality of markets, perhaps can tell us a little bit more about that.
Yeah, maybe I think now is a good segue to go into the kind of where things are headed going forward, because it does strike. I mean, this is also a backward-looking point, but that a country like Italy, that when they joined the euro, effectively their currency sort of appreciated, while Germany had depreciation in some ways. And so Italy has never been able to sort of get out from under the debt that that accumulated in previous decades. And I'm talking to two economists, which is always nervous as a non-economist. So Nicolas, please correct me. But it does seem that one of the ideas with the Hamiltonian moment is like, okay, let's put this all in one pot. Let's issue joint EU debt. The way that the U.S. does with its dollars, and one of the problems with the euro is there just isn't enough of it for people to buy on the open market. Your colleagues have a really interesting paper at the Peterson Institute, Olivier Blanchard and Angel Ubide, that say now is the time for euro bonds, not just to issue some more debt to pay for Ukraine or defense, but to mutualize debt as well, have this Hamiltonian moment. What do you think about that proposal? Maybe you could, and anything that I said that you disagree with, please feel free to unpack and correct.
No, maybe first a brief word about Hamilton, and I'm not going to try to sing about it, but Hamilton was super important, indeed, the assumption of state debt from the Revolutionary War. But it was not the moment when the U.S. fiscal union was fully formed, and then there was a very protracted sequence because that was a one-off transaction of assumption of state debt. But then the state continued to go into debt, and actually much more than the federal government in the early 19th century. So if you think of all the infrastructure spending of the Erie Canal and the early railroads and so on, all that was state debt to the extent there was public debt involved. And then you had an important moment, which was a string of state bankruptcies or, stress in state finance in the 1830s, early 1840s, so 45, 50 years after the Hamiltonian moment. But that created discipline because it demonstrated that states could fail and the federal government would not bail them out and didn't have the means to bail them out. But then you only had a consolidation of the federal fiscal capacity and its affirmation as basically, the hegemonic piece of the US fiscal framework during the Civil War, so 70 years after the Hamiltonian moment. This is to say, of course, the EU story is different from the US story. I don't want to establish direct parallels here. Just to say that these processes take time. They don't happen in one go. And even Hamilton, which is kind of the closest that the US had of this, actually was the beginning of a very long sequence. So if you fast forward to now and the EU, I think everybody understands that it would be very advantageous for the EU to have a fiscal union. It would, actually, the citizenry like the idea. They want the EU to do more in terms of defense, in terms of security, in terms of foreign policy. And the citizens understand that this requires funding, and it only makes sense to fund this centrally. But there are huge inertia and special interests that go against this, starting, of course, with the political establishments of the member states, because they like the idea of fiscal sovereignty at the national level, which is entirely natural. So here we come back to your quote from Jean Monnet. Jean Monnet said famously at the end of his memoirs, and he was kind of the intellectual and largely practical architect of European integration, the European Union, Europe, he said, in the wording of his time, will be built through crisis and will be the sum of the responses to those crises. This, in a way, is a pessimistic statement. It means we cannot fix it without a crisis. But it was based on his experience and observation. I think if you look at the history of the EU, it is a little bit more uplifting. There have been things that have been done through crisis, and banking union, as we discussed, is a very good example of that. Actually, when you look at the euro itself, it started without a crisis. It started from the wisdom and foresight of statesmen, they were mostly men at the time, like Jacques Delors, like Helmut Kohl, in particularly those two, who understood that Europe would go into big difficulties if it didn't have a single currency, and who initiated a movement. People say it's a Cold War. The Delors report predated the Cold War. So the initiation of the sequence of policymaking that led to the euro, of course, it was facilitated by the fall of the Berlin Wall, but did I say predated the Cold War? Predated the end of the Cold War. You understood my point. So the process was initiated not in crisis, but just out of a considered analysis that this was what Europe needed to be resilient. I think for fiscal union, we have things of a similar nature. There's a lot of debate. I think at this point, it's not yet ready for show. I don't think it is likely that the Europeans will be able to build a robust fiscal union just out of foresight in the very near term. But I think it will happen one day. So if you take the long view, there are good reasons to be optimistic. For me, there is no contradiction in acknowledging that fiscal union without a crisis is unlikely in the very near term, which is sad, but a reality. I would defend that view. And the fundamentally optimistic view that it will happen one day. It may even happen without a crisis. It's just a matter of opportunity and circumstances.
Can I just ask one clarifying question, which I think is helpful for me in the audience? So when we think of fiscal union, are we saying basically it's going to look like the United States government, where it issues debt, it has a large budget, it's spending a lot, it's taking taxation? How would you think of fiscal union?
My definition of fiscal union indeed is that to be able to issue debt at scale without limit, and as much as you need it to be backed by some form of revenue. And this is where the political difficulty lies. Right. And here I would probably differ a little bit, probably into details, from the colleagues you mentioned, Blanchard and Ubide in their recent paper, because they don't really go to the core of that issue. They think that financial engineering can fix it, and I'm more of the view that financial engineering can be very useful. We may come back to the reparations loan for Ukraine, which is a very good example of that. But when you have a fundamental political problem, which is the absence of EU-level government revenue or public revenue, I don't think you solve that with financial engineering. So in my view, fiscal union will mean ultimately an ability, at least in theory, maybe not in practice, but in theory, to raise revenue at the European level. Probably you need a little bit of practical demonstration, proof of concept for that theory to be plausible, and we're very far from that.
Yeah, absolutely. Basically, going back to what I said before, the question is who's the ultimate taxpayer? So basically, when you're buying a long-term bond issued by the European Union, if that ever happens, who is backing that, right? In the case of the United States, it's quite clear. You have the US economy with its capacity to generate economic growth, its military capabilities. Normally, historically, you have sovereignty, a currency, and the military together. This is not the case in Europe, which is very interesting, but also opens a lot of questions. And it's not clear if it's, is it the German taxpayer? Is it all the taxpayers in Europe? To what extent, given the different levels of income, given the different levels of, commitment to give money to their elderly with the pension systems? You retire at 62 or at 65 or at 67. So that's the political question that many times the creation of the euro has been a top-down technocratic project in the beginning, which made sense. But, now we're getting to the really hard distributional issues, right? Now, coming to this point is where we have these proposals. And, the paper you mentioned by Ubide and Blanchard basically makes 3 points. They don't get into this political issue, and I think it's important, but they say, there's a need for the European Union to have more strategic autonomy, and that requires financial strength, and that requires a safe asset. We can get into what that means also in terms of monetary policy and the capital markets union. And Draghi, every time that he speaks, says, we need a safe asset, like a bond issued by the EU equivalent to the US Treasury bill, which is the most liquid asset in the system, and is a benchmark for everything else to compare and to do monetary policy with that in mind. But second, there's an opportunity because of the discussion around the willingness of many central banks, many investors to diversify away from the dollar, given the very high level of debt of the US, which is going to increase with the One Big Beautiful Bill, and then issues like independence of the Fed and elements that might make the dollar less interesting. Because up until now, what has happened is that the currencies are none of them are perfect, but the dollar is the least bad, if you want, because the renminbi, that you have capital controls in China, so forget about it. In the euro, you don't have the fiscal and political union, but now you're seeing some discussion of decentering the dollar. That's how Adam Posen, for example, calls it. And then finally, for the first time, you have the European Central Bank talking about internationalizing the euro, which is something new. The European Union has always been very cautious about this. Particularly, Germany never wanted to internationalize the Deutsche Mark. Japan, the same with the yen, because that sometimes, makes responsibility of being, the lender of last resort of the international system, volatility on the exchange rate, things that, export-oriented economies don't really like. But this current context opens the door for, this conversation to be more present, which doesn't mean that we can avoid the political element that Nicolas was mentioning.
I want to get to the questions about the U.S. in a minute, but maybe to get a little bit more micro, you Federico and Nicolas, you talk about needing sort of the bill payer, right, to the person, the individual to be backing, but isn't that what European countries provide? Right now, the EU budget, everyone is sort of tapped on the shoulder to chip in 1% of GDP or 1.1% of GDP. And currently, with the Next Gen EU, this is the money that was borrowed by the European Union in response to COVID. That is sort of going to be paid out of the EU budget. So essentially, everyone is sort of on the hook to paying for that. Now, the challenge is that that's going to eat into a lot of what the EU can spend on. There's questions of whether that should just be rolled over indefinitely instead of paying back the loan. Do you continue to roll it over? So, maybe are we overcomplicating who's going to pay, because, well, it's the member states that then agree that the EU is, and they can then go tax their citizens and figure out how they're going to get the money to meet the EU.
Yeah, I mean, it's the problem is that this has very serious distributional consequences.
Right.
And the beauty of a fiscal union like the US is that you don't have to be negotiating every time from the federal government, there's more money going to California than to Texas for whatever reason, you don't need a political negotiation because you have a mechanism and an understanding of what this means. At this point, the EU countries still negotiate over all these things. Next Generation was a one-off. There's this idea that just because it was a one-off, it's not clear that markets are actually pricing in the cheaper borrowing by the EU because they understand that perhaps this is not done again. I think it will be done again, but on small amounts.
Next Generation EU is limited both from a legal and from a financial perspective. It's limited from a legal perspective because according to the treaty, you cannot make it permanent. So it is temporary in nature. It is limited from a financial perspective because what you refer to, the backing of Next Generation EU, is from the EU budget, the so-called multi-annual financial framework, the MFF. But that's what they call the headroom, so the available financial space in that budget that backs Next Generation EU is limited in size. And therefore, there's only so much you can borrow based on, backed by the MFF headroom. That's the best guarded secret, or even maybe something impossible to know, but in principle, it's limited in size, and that's at the core of the current arguments about how to help Ukraine. The question is, how can you make that unlimited in size and permanently available? And that's what would define a fiscal union. So basically, the instruments we have don't allow for that. They allow for a repeat of Next Generation EU. We could have a Next Generation EU 234, but we cannot have a permanent mechanism. Just a comparison with the US, think of a US appropriations mechanism where not only you would have a debt ceiling, which is absurd, but that's a different debate, but you would need unanimity of all the governors of the 50 states. That would be a different United States.
Maybe let's get into the weeds on we'll go back to my first question, which I think we've done a good roundabout to get there. But there is a proposal on the table, European Commission, looking at the frozen Russian assets in Euroclear. It's roughly 200 billion euros. Some of that's already tied up with a G7 loan. So it'll be about 140 billion that the EU would not seek to claim, but would seek to tie a loan to, which would basically prevent that money from sort of going back to Russia. There's concerns from the Belgian government. Nicolas, what do you think of this proposal? Does this make sense? Should the EU bother with this complicated effort, or just do what it did with Next Gen EU? What is your take on what is currently in front of the European leaders and the European Commission?
I think it's a great idea. As I said, it's financial engineering at its best, and financial engineering indeed can help you improve the way you manage some problems. So why is the reparations loan better than just borrowing the money? A, it's cheaper. It's a zero interest loan. B, it is not counted under EU rules as national debt, and that makes it much less painful for the member states. C, it allows for the upfront mobilization of a very significant amount of money. As you said, 185 billion euro in total. You reimburse 45 billion euro for the so-called extraordinary revenue acceleration loans that were granted last year. You still have 140 billion euro for Ukraine, which is really a big. There would be a discussion, of course, with the Ukrainian authorities on how and how fast to spend it, but it would be a very big reassurance to Ukraine that they have a lot of means to keep fighting. So it has a number of advantages, and it's better than the option of borrowing, either jointly or separately, by the different member states. There is a leak today in the media of those three options, separate borrowing, joint borrowing, and the reparations loan. And that's a document from the European Commission. It is very clear from that document that the reparations loan is a preferable option. And I believe it is very likely to be adopted given the compromises that the European Commission appears likely to make with special interests that are being defended in Belgium. So from that perspective, this is very helpful for Ukraine. It is important to understand, and that often gets lost in the debate, that it arises from a very unique, very particular situation that we have with Euroclear, this financial infrastructure company in Belgium that has very specific terms and conditions. The Russian central bank didn't expect to be trapped at Euroclear. That's what happened to them in February 22. This was a very deft policymaking by the Europeans. Mario Draghi gets a lot of credit for that. But that's a unique situation. So this is not replicable. This is not scalable to other parts of the fiscal union debate.
Now, let me sort of, it does seem that Europe now has, well, it doesn't seem. Europe now has lots of things that it needs to spend money on. So it needs to spend money on a war. It may not be directly fighting, but it is providing the funding for Ukraine, especially with the U.S. not there. I think I've had one European official sort of estimate it's around 75, 80 billion a year that Ukraine needs in terms of financial support, both on for the military side and for its economy. And so if it's a 140 billion euro loan, that's good. That's great. Gets you the next 2 years. But there's also this need for the Europeans to rearm. There's also the need for the energy transition, and while we're walking away from that here in the U.S., Europe is importing all its fossil fuel energy, or almost all of it, and so to be price competitive, need to really invest in infrastructure in the clean transition, and then we have social payments, elderly population, demographic problems. How is Europe going to sort of pay for this? And then you look at a government like France, and debt ratios are above 5% of GDP. So are we going to see more next-gen EUs? Is Eurobonds the next step to provide some of the European public goods to create some more stimulus? Federico, what do you think?
Yeah, I think the key is economic growth and productivity increases. And this is, when you're growing, you have a little bit of inflation, then the burden of debt, relatively fast is reduced, and you can do other things, right? So I think there's a discussion to be had about joint borrowing and Eurobonds specifically for defense or for other things. But the key necessary thing for the European economies at this point is to implement the recommendations from the Draghi and Letta reports, reduce the obstacles within the single market. There are many issues that have to do with capital markets union, or now we call it savings and investment union. Nicolas might say a lot of things about this, to have the resources available for investment. As you mentioned, in the European case, investment or changing the energy model is as much about security and independence from Russia as it is about fighting climate change. So, decarbonization is not really an option, it's a necessity. And if done well, it can improve economic growth as well. So basically, most of the homework has to be done domestically, and the issuance of debt or rethinking taxation is part of the equation, but I would say it's not the most important element. We have to do more things for other countries to grow as fast as Spain is doing now.
One of the major points, as Federico points out, in the Draghi report, a major thrusts of recommendation, the capital markets union. Nicolas, you're sort of like the godfather of this concept or idea, or been part of thinking about this for a very long time. Maybe you could talk about what is the current state and why is this so critical? Oftentimes here in the U.S. we say, oh, well, the problem with the reason why there's no big European tech companies is because of all the regulation that was passed 2 years ago. When I think if you really look at the source, it's much harder to just raise a huge amount of capital to really expand your business. But maybe you could talk about the capital markets union or savings and investment union, the way it's being reframed. And there's been complaints that there hasn't been a lot of progress in implementing the Draghi report. How do you see things progressing? So first, what is it? Why does it matter? And where are things going there?
So the Savings and Investment Union is just a vision of an integrated financial system. So it's kind of all-encompassing. The idea is if you have a single financial system, it allocates capital, it intermediates savings, it funds investment. And if you have one system instead of 27 national systems, it does it much more powerfully, much more efficiently. So that's the Savings and Investment Union. And then in the rhetoric of the Commission, this is sliced and diced into basically two big pieces. One is the Capital Markets Union for non-bank securities market, financial services, and the other one is a banking union, which is still unfinished. We'll come back to the fore one day, even so at this point it's kind of frozen like the assets of the Bank of Russia at Euroclear, and is also part of the picture. So essentially, if you think of it this way, there are two big pieces, one which is still lurking in the background, but will come back to the forefront I think next year, which is the completion of the banking union, this unfinished business of creating a single framework for crisis response, including but not limited to a single deposit insurance, or the unfinished business of the sequence that started, as we recalled, in 2012. And the other one is for securities market, how can you get into one single system that basically gives a kind of IPO machine and listing machines that you have in the US. And for that piece, the non-bank piece, the capital markets union piece, I would argue that there are many things you can think of, and of course we need powerful institutional investors. That goes back to pension reform, something that Federico has mentioned, but which at this point is basically national policy, national social models. So if you think of it in terms of the EU legislation, what the EU legislators can work on and make a difference, it's mostly about the oversight of the system. So basically the debate about capital market supervisory integration, what Christine Lagarde 2 years ago in an important speech has called the European SEC, like the US Securities and Exchange Commission. Mm-hmm. If you have a single authority in charge of enforcing capital markets regulations, reporting requirements, things like that, then you will have a convergence of practice that is catalyzed, accelerated by this single authority. And I think that's where the core of the debate currently is. So we are expecting actually a legislative proposal from the European Commission very soon in December. We'll see how it goes. Maybe it won't be ambitious enough, but it will be a start of that conversation, of that cycle of the conversation. I think it is essential because this is a key infrastructure of the currency itself. You don't have a strong dollar in the global financial sector if you don't have this strength of US capital markets. And people say treasury bonds, treasury bills, US government securities, but actually people want to invest primarily in US equities because the equity market is where you have the power of the US scale and of what we see now in tech and AI. So I think creating a European equity market that would be singular, not plural, whatever the technical details of that, is really what is at stake here that you would that you could achieve with appropriate reforms. Think of this: the index providers in the market, the MSCI, S&P, that kind of market. Informational intermediaries. At this point, they look at European equity markets country by country. Mm-hmm. So you have a bunch of countries like the Baltics, like Bulgaria, which are frontier markets. You have some countries like Poland, like Hungary, which are emerging markets. And then you have developed markets more in Western Europe. We will have a single European equity market when these index providers think of the EU as a relevant jurisdiction, not country by country.
And this is what Friedrich Merz, the German chancellor, gave a speech recently where he called for a European stock exchange. Has that been a big political shift from in Germany into shifting in support, or how would you sort of assess the politics of this?
I hope so. I think we're still waiting for clarification on what exactly the German coalition has in mind. There were also, importantly, very ambitious pronouncements, not just by Friedrich Merz, you mentioned that, but also by Klingbeil. He's a coalition partner and finance minister. So we have ostensibly a non-precedented level of ambition in Germany, and all of us observers are eager to see how that can translate into practice.
Right. If the Franco-German engine that can drive European integration forward,
or even if the Germans can, drive the French, which I think corresponds to the current situation.
Yes. Maybe a final question. We'll go back to where the kind of current international currency landscape is, right? There's a lot of concern about U.S. debt levels, about the central banks, the Federal Reserve's independence, and concerns about an AI bubble here in the United States is sort of consuming a lot of the economics conversation. How is this dynamic in the U.S. and also maybe some fracturing in transatlantic relations with NATO and the Europeans sort of not being clear that they can totally rely on the United States? How is that shaping this conversation in Europe about the role of the euro and about potential reforms and actions to maybe not necessarily create a like-for-like rival to the dollar, but to begin to try to play a bigger international role? Federico, maybe we'll start with you.
Yes, I think that people are excited about all this discussion about the euro, but at the same time, the more they know about the history of the euro, as we discussed here, and about the technical and legal constraints, they are very cautious, right? So I think at this point, most people would argue that as long as the US doesn't do a lot of damage to its credibility, the credibility of the dollar in terms of the rule of law, especially, and skyrocketing levels of debt, which, they can still go up a bit, but at some point you have to adjust. And then even if there's a correction in financial markets, in the II, if there's a bubble, that probably will not be, a financial crisis like the one in 2008, because it's not based on the banking system. Mm-hmm. It perhaps might be more similar to the dot-com bubble of the 2000s, which is not systemic. So basically, it's up to the US and what it does to undermine or reinforce the role of the dollar. And there's all these discussions about stable coins and how those could increase the demand for US Treasury bills and internationalize or strengthen the role of the dollar through new and informal channels. Having said that, what's true is that the level of reserves on central banks that are in dollars has been around 60%. It probably peaked in 2015. It has gone down in the last decade, not in favor of the euro, in favor of other currencies mostly. And the euro represents a little bit more than 20%, and it has been like that even since the beginning. So there's an opportunity, as we said, because of these geopolitical shifts. But I think that in this case, it's important that the European Union it's true to itself and keeps its ship in order with these ideas of rule of law, institutional stability, and slowly starts exploring avenues for the development of the international role of the euro, keeping in mind that, as we discussed, you need to do your homework domestically first, and then you can project. So there are necessary conditions that are economic, so having those markets, having the tools, and then you need a political push, mm-hmm. which is slowly emerging, but is not what it has been with the US, because that requires also a military element that the Europeans are also constructing.
I think this is a very dynamic scene, and indeed, following the sequence of March, April this year, which, by the way, started with the Munich Security Conference, the cracks in the Atlantic Alliance, a disastrous meeting in the Oval Office between Trump and Zelensky. There's been a lot of reflection on this question of key currencies, and I think there are three things that are relatively new or very new on the side of the euro. The first is banking union, in the sense that now we have a very established layer of resilience in the banking sector that didn't exist 15 years ago, and I think that's important. But the other two are much more recent. One is the shift that Federico referred to earlier in our conversation in the stance of the ECB. The ECB is no longer shy about providing euros to the world. In technical terms, that means providing swap lines to credible counterparties around the world if they want to use the euro on an offshore basis. Mm-hmm. And until 2018, more or less, the ECB had maintained the old Bundesbank stance that basically we don't want to talk about that. This is not something we're ready to consider. And in the last 6-7 years, they've been increasingly explicit. And I think really the watershed moment was a speech that Christine Lagarde gave in Berlin in May this year, May 2025, when she essentially said, we have those swap agreements, they're here for the taking. If people need them, we can provide them. Hmm. So that's very significant. The other thing is the assistance to Ukraine. If you go back just a year ago, around the time of the US election, the consensus in the market was if Trump wins, the US withdraws financial support to Ukraine, the EU will follow the US, and Ukraine will be screwed. Actually, the opposite has happened. We've seen in the last 12 months, in fits and starts, and now with this debate about the reparations loan, we'll see how it goes, but basically the EU stepping up to its new role and offsetting the decrease in US funding, which, by the way, started during the Biden administration, and providing more and more funding to Ukraine essentially doing whatever it takes for Ukraine to continue the fight. We'll see, it will be bumpy, it's not going to be smooth, but this is a fundamental new data point because we know from the literature and from experience that key currencies are linked to geopolitical influence and heft. And therefore, this ability of the EU to do something in the security space, which has a completely unprecedented scale and significance, not just for Europe, but for the world, is a new data point. So I think if you extrapolate these, we have a dynamic situation about currencies. Of course, the dollar's centrality is very stable. I think you will need a lot of further action of the Trump administration to undermine that and put an end to it in the near term. But we also have a lot of moving pieces that are significant to that debate.
I think that's a great point to close on. Maybe one sort of final thought that, if you look at NATO, there's sort of an unwritten foundation of NATO is U.S. financial support. World War I, it was J.P. Morgan providing financing Lend-Lease from the U.S. in World War II. And then if there was going to be a third World War or other conflict, the U.S. would come militarily, but there would also be strong financial support. And one of the things I've heard from a senior official in a Northern European state, sort of close, along the front line, a very frugal state that would oppose the concept of Eurobonds, intrinsically, suddenly realizing, well, if they got in a conflict with Russia, they don't want to be tied. They don't want to just be on the hook to be the ones borrowing to finance their national defense, because they would want Europe to have that capacity and capability too. So thinking about the ability to finance is also intrinsically tied to your ability to finance your war effort. And I think that is sort of prompting what Ukraine is sort of prompting, that reconsideration, particularly countries that are historically frugal, strong supporters of Ukraine, needing to get money and financing to support Ukraine, especially if the U.S. is not going to provide it. I want to thank you both. I think this was a fascinating conversation on the Euro's both history, future, and present, obviously. If you enjoyed this conversation, please sign up and subscribe to the Eurofile, which is a bi-weekly podcast we do here at CSIS, where we look at Europe through a Washington lens, where we have lots of conversations like this. So thank you so much for joining at home, and please catch us next time.